So if you follow options volatility at all, you've probably noticed that it has dropped into its lowest level of the year right now. Now, there's nothing to say that those levels will not persist for a while. After all, it's summertime, and while summers can be extremely volatile, like in August of 2011 and August of 2015, oftentimes summers can be extremely quiet as well, as traders are away on vacation or just spending more time on leisure activities and less time trading. The strategies we trade on our options trading desk here at SMB are structured such that when we enter trades in low volatility environments like we are in right now, they can on occasion be subject to a drawdown with a large increase in options volatility. So some traders have developed a companion trade that does quite well when there's a spike in options volatility to balance their trading portfolio. But it turns out that the trade actually, on a standalone basis, if traded correctly, can be its own profit center, not just a hedge for the rest of your portfolio of trades. So if you're interested in how professional traders actually take advantage of increases in options volatility, then I'm sure you're going to be interested in this video, so stick around. Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, you'll want to click our subscribe button right now so that you don't miss any of our free trading videos produced for the trading and investment community. Now, in this video, we're going to be reviewing a strategy that involves the selling of puts in the VIX, which is the CBOE index that indicates how much fear is in the market and therefore how much time premium options traders are willing to pay to hedge away their fears. The premise of the trade is actually pretty simple and logical, and I'll be running you through the logic and how it is executed in just a moment. I think you're going to find it compelling. And while we're talking about option strategies, if you'd like to learn 3 more real-world option strategies that our traders use, including the surprisingly simple and powerful strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit, whether the stock goes up, goes nowhere, or even goes down a small percentage, then you should check out the free options class that we're currently running. So just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open a free registration page in a new window, so don't worry, you won't lose this video. You can also visit optionsclass.com to register for this free intensive workshop. It is a rare opportunity for retail traders and investors to learn directly from Wall Street professionals, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. All right, so let's get started. Now, you've probably heard of the VIX. Sometimes it's called the fear index, and basically it's a measurement of how much the options market is expecting the market in general to move over the next 30 days. The VIX formula is complicated, but it's not really necessary for you to know the details of how it's calculated. To trade this strategy, you only really need to understand that if the VIX is trading at a low level compared to normal, it means that the options market isn't expecting dramatic moves over the next 30 days. On the other hand, if the VIX is trading at a level that is larger than normal, then the market is expecting abnormally high levels of movement over the next 30 days. You'll often get low VIX readings when the market isn't expecting a lot of earth-shattering news in the near future. And you'll often get high VIX readings when the market is anticipating a major event like an important election or an important decision of the Federal Open Market Committee, the FOMC, or a highly anticipated jobs report. The assumption is that after the event occurs, the market will have a large reaction to that event, either positive or negative, and if you're caught on the wrong side of that move, you get hurt. So you're willing to pay a larger amount of options premium than normal to protect yourself against that. So you're probably asking, well, what exactly is a normal price for the VIX? Well, that is really a relative issue, as you'll see from this price chart. So as you can see, the VIX, just like any other trading instrument, has areas of resistance, but more important, fairly well-defined areas of support. For instance, in the last few years, 2018 to 2019, the VIX seems to bottom out around the 12 area. Back in 2013, 2014, the VIX rarely got lower than 11. The support areas change, but you can pretty much eyeball the areas where the market will not get much more complacent than that level. In other words, you could look at the market reaching a support level on the VIX as basically an indication of a great deal of complacency in the market. But you'll notice something else interesting about this chart, and that is that emerging out of the times of relative complacency, you'll get these spikes, sometimes massive spikes in options volatility, and thus the VIX spikes up dramatically as well. You can see that happened back in a big way in the summer of 2011 and in the summer of 2015. It also happened in early 2018 and again in late 2018. During these big spikes, you'll often get a VIX reading of 30, 40, or even briefly 50. That's a lot of fear, although that level of fear rarely lasts very long. You will also notice smaller spikes that take place almost every year, multiple times. And so this movement from the periods of complacency into the medium or large spike periods are where our opportunity lies through the use of VIX options. Now, VIX options are a form of index option, and they pay off in cash just like an insurance policy. For every point that the VIX index drops below the strike price of your put, you will be owed $100 per put that you own. So for example, if you buy a VIX 14 put and you pay $60 for it, and the VIX drops to 12, you're owed $200. So you'd make a $140 profit on that transaction because you were paid $200, but you paid $60 for the contract, so your net profit is $140. And incidentally, if the market closed at 14 or higher, you'd be owed nothing. So you'd lose the $60 premium you paid for the option in the first place. On the other hand, let's say instead you were the one selling that put. Well, you would have lost the $140, and conversely, if the VIX closed above 14 on the day the option expired, you'd get to keep that full premium of $60 that you were paid in the first place to sell that put option. So now let's think about the risk-reward situation when the VIX is at support. The chances are that it will not drop too much further, as by definition, its tendency is not to fall below that level very often. But if you get one of those spikes in the VIX that we just talked about and the option expires, then you will just pocket the premium that you sold that put for. So the risk is on the small side, whereas the reward is potentially the pocketing of your entire put premium. And the best part is that you don't need to wait until the option that you sold expires. When the VIX spikes, then the put naturally loses value quickly, because now the chances of the market dropping back down to that support level before your option expires has just been reduced significantly because the market is trading so much higher than that. So you can frequently close your short put, in other words, buy it back, which ends your obligation to the one you sold the put to. And because the VIX has spiked, you'd be doing so at a much cheaper price than you received for the put when you originally sold it. So you're basically scalping the spike in the VIX. Now let's take a look at an example to see exactly how this works. So let's go back to January 18th, 2018. You can see that the VIX was trading around 12 at that time, which was near a support level on the VIX during this time period. Now, if on that day we sold 10 VIX puts at the 12 strike price, we would have collected $1,250 of premium for those puts. Your broker would have required about $2,400 of capital for this trade, incidentally. So what we're playing for here is the spike in the VIX, which actually happened 3 weeks later in the week of February 5th. Now, let's analyze what happened here. The VIX spiked into the 30s in the first full week of February of last year and then pulled back to 23 in the middle of that week. At that point, the puts that we sold for $1.25 were now worth 22 cents. Why? Well, with the VIX at such an elevated level, the market was assigning very little value to the possibility of those puts having any value when those options expired, which in this case was 42 days later on March 21st. So the math works like this. You originally sold the 10 puts for $12.50. If you had decided to buy those 10 puts back at 22 cents, you'd have to pay $220 to close the transaction, which would have netted you a $1,030 profit. So what's the major takeaway from this example that we've shown you today? That there is a very solid risk-reward trade that exists when the VIX drops into a support area and the market has become complacent. You need to be patient and wait for these opportunities. And there are other nuances that you'll want to develop as far as a minimum amount of income you'll want to enter into this trade for and the right time to close it for a profit. But I wanted you to see the basic setup so that you can then make this trade your own and craft some parameters around it. Now, some traders use a rule of thumb that they'll close the trade when the put has shrunk to half of the original credit you received for selling that put at the outset of the trade. But the tendency of the market to get complacent and then suddenly develop a great fear around some issue is a repeated pattern that you can play as your trading skills develop. Just to remind you, as I said earlier, if you enjoyed this video and would like to learn 3 more real-world option strategies that our traders use, including the simple and powerful strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, whether the market goes up, goes nowhere, or even goes down a small percentage, then you should check out the free options class that we're currently running. Just go ahead, click the link that should be appearing now at the top right corner of your screen, and that will open the free registration page in a new window. Or you can just go ahead on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Now, one more thing I'd like to ask you to do is to go ahead and click our subscribe button so you don't miss any of our trading videos produced for the trading and investing community. And while you're at it, please add your feedback in the comment section for what videos you would like us to provide next, as well as what you found helpful from this video. So from all of us at SMB, trade well.